you're going to get crushed. I'm your host, Steve Van Metre, and thanks for joining me today. And Morgan Stanley says to forget focusing on the Fed. It's corporate earnings that are going to send stocks crashing. Let's head over to Bloomberg, where we picked today's story up. With stock indexes face fresh low this year, as Morgan Stanley's Wilson says, the market is being too optimistic about the earnings outlook. The index usually is the last thing to fall, Wilson said, who predicted this year's equity sell-off. June probably was a low average for the stock, but the index, we think, still has to take out those June lows. And he's right, because it is usually a stock market that's the last thing to figure out that the economy is heading into a recession or some kind of slump, and it is a lagging indicator of what's really going on. So he's absolutely right. We view 3,400 for the growth recession or soft landing, and that would imply a 15% slide for the S&P 500 from Tuesday's close. A proper recession would bring the index somewhere close to 3,000. And while it's difficult to predict a market bottom, the bank chief's U.S. equity strategy said the direction is down, at least for the next quarter or two. But one thing we note is no one's really talking about the probability of a financial crisis and where stocks could go if that happens. We look at what's going on in China. You see the real estate sector imploding, likely to drag it into a recession at the worst case or the best case scenario. How about Europe? The kind of the best case scenario for Europe is a recession with what's going on with their energy crisis. They're likely to head into depression, but global investors see the U.S. as a safe haven. The point of salvation is U.S. equity market, but usually it's the last shoe to drop. And if we have a global financial crisis, well, those targets from Morgan Stanley are going to look optimistic. Let's continue on as U.S. stocks struggled to find solid footing in the final day of August, a month that has seen everything from treasuries to commodities retreat as central banks ramped up their efforts to thwart scorching inflation. Investors anxiously awaited Friday's jobs report, which should provide more clues on the pace of Fed rate hikes. And of course, we know from our chief strategist, Jeff Snyder, that the smoothing effect of the non-farm payroll report suggests that it will probably be good enough to keep the Fed on track for September. Trends in operating margins were worse than forecast, Wilson noted, while adding that he expects this negative direction to continue. PE multiples is wrong, not because the Fed is going to be hawkish, but because the equity market is being too optimistic about the earnings outlook, Wilson said, referring to the PE ratio. The multiples will start to come down as earnings get cut, and then somewhere in the middle of that earnings cut process, the market will bottom, and we think that's what's probably between September and December. But notably, if the Euros-Dollars futures curve is right and the yield curve is right, September or December will just be the beginning of what we will see coming for a horrible next year. But let's dig deeper into the Morgan Stanley report and their weekly warm-up. They note that the Fed hits stocks, but the larger risk remains earnings, as we talked about, not rates, as Powell and the Fed make it crystal clear that their jobs fighting inflation remains unfinished. Ironically, while bonds took the message in stride, stocks seem to be shocked by the message. Earnings are the bigger risk for stocks from here. Almost all of the weakness for stocks during the first half of this year was due to the Fed and tighter financial conditions. The second half outcome will ultimately be determined by earnings expectations for next year, and as a result, equity investors should be laser focused on this risk, not the Fed, particularly as we enter the seasonally weakest time of the year for earnings revision and inflation further east into margins and demands. And notably, when we talk about where corporate profits and earnings and all those things are headed. Now, in the Fed database, the St. Louis Fed, we don't have, earnings. We do have profits, though, and that's a good enough proxy for earnings for sure, because really the story here is the Fed's balance sheet seems to have a high correlation with corporate profits. As we know, the Fed is going to accelerate their balance sheet runoff this month. They're going to double it, but there's also another factor is there's a lagging effect to when they unwind their mortgage-backed securities. So a lot of people have been commenting that, hey, the Fed's really cheating here. No, it just takes a while for those to hit, and those are going to start hitting this month. So check this out. We've got corporate profits in blue against the monetary base or the Fed's balance sheet. And notably, you can see when the two are going up together, they do. And then as the Fed, of course, starts to drain its balance sheet off, what happens? Corporate profits start to head lower. And they did it once, they did it twice, and now we could expect that to happen again. It's a little easier to see on a year-over-year rate of change as the monetary base starts to decelerate, or even worse, contract. It tends to lead corporate profits. Well, the exception here is when the market believes that things are going to get better and the Fed's going to pivot, but in this case, no chance with inflation running hot. And the leading earnings indicators point to weakness ahead as they remain focused at Morgan Stanley on the spread between forward sales growth and the rate of change on the producer price index and the spread between nominal GDP growth and wage growth. Both indicators suggest margin pressure and earnings growth risk ahead. The view is confirmed by our leading earnings model, which projects a steep fall in EPS growth over the next several months. A key input to this model is the ISM manufacturing PMI and leading regional Fed manufacturing surveys, which point to continued downside in the ISM data. The rate of change on earnings revision breadth also leads forward EPS growth and points to growth downside as well. And there's one thing that shouldn't be facing weakness if Morgan Stanley's right, and that's your portfolio. I'll put a link up here to Portfolio Shield and in the description below because Powell is coming back in a big way as he abandons his soft landing goal as he seeks growth recession. The Fed chief wants weak growth, soft jobs market to cut inflation, but will it work? It's known to economists by the paradoxical name of a growth recession. Unlike a soft landing, it's a protracted period of meager growth and rising unemployment would stop short of an outright contraction of the economy. To put it in perspective what the Fed's trying to do, imagine you're running and you just want to slow down to, say, a fast walk. That's what an earnings recession is. Of course, we know based on the Fed's track record, which is really poor, that they are likely to not try to, as they try to decelerate to a fast walk, they're going to trip and faceplant right down. But we know that because that's what they do. Now, the soft landing they did achieve was in 1994 to 1995, and then we went on to have the big run up in tech stocks, followed by the huge crash as the Fed slowed the economy briefly and contained inflation through a doubling of interest rates. But the unemployment rate never really rose, which we're seeing it do now. In the late New York University economist Solomon Fabricant coined the term growth recession in research back in 1972. While such a scenario may not be as costly as an actual contraction, it does pose dangers for the economy nonetheless. And the reason it's dangerous is because the Fed gets it wrong, which they probably will. Faceplant, that's what's coming for the economy. Reducing inflation is likely to require a sustained period of below-trend growth, according to Powell. Moreover, there will be likely some softening of labor market conditions, preparing people for higher unemployment. Of course, we'll get some data on the Labor Department here on Friday. But first, let's head over to Jeff Snyder, who talks about the ADP report, as our chief strategist notes that the ADP released a new series, including updates for June, July, and now August of this year, which showed slower payroll growth. Unfortunately, they show a clear slowdown in employment beginning with May through really accelerating to the downside July plus August. He notes in his daily that what's left unsettled is whether this, again, a red-hot economy cooling down to more normal levels of payroll expansion, as is constantly claimed by all mainstream sources taken from the FOMC's interpretation, or if what we see is a wide variety of data might instead be the first and opening stage of recession. The August ADP change is uncomfortably close to the latter, he says. Now, if you want to know more about what Jeff says and our injury and materials expert, Tracy Schuchart, be sure to click the link below for Markets Insider Pro. It's currently free, but not for long. As we dig in deeper into the payroll data, from today, we see U.S. jobless claims declined for a third week to a 2-month low, down about 5,000 to 232,000 for the week ending August 7th. But continuing claims for state benefits, notably here, rose to 1.44 million in the week ending August 20th from 1.41 million, suggesting that people aren't able to get jobs quite as quickly as the Fed's job opening, or not the Fed's, but the BLS's job opening and labor turnover survey suggest. But what doesn't maybe make some sense here is if the economy is so strong, why do we see headlines like this where oil posts the third straight month of declines? Well, maybe there is a relationship between oil prices and initial claims, and sure enough, there is. What we see is initial claims here, the 4-week moving average in blue against West Texas Intermediate in red. There's a certain point where claims start to have a negative effect on oil prices, and that causes demand to fall. We see that here going into that 1992 recession. We see it again going into the dot-com bubble. There just gets to be enough claims where demand falls. We see it during the great financial crisis where oil surged in price, claims started falling in higher, and then boom, caused that bubble to burst, and now we're starting to see that sign again. Now, we have our weekly from Tracy Schuchart, our energy and materials expert, who talks about the bullish case for U.S. shale. And for those of you who are into nuclear, she gets into that too and makes her bullish case for uranium. Again, all you have to do is sign up. It's still currently free. And with that, you can see that Morgan Stanley's probably right here, except one exception is they think things bottom out by the end of the year. But I'll tell you this, I think things just get started by the end of the year. And with that, I'm Steve Van Metre. Thanks for being fans. Thanks for watching. Bye now.